Hello everyone and welcome to this week's FX update. My name's Craig Erlam, Senior Market Analyst at OANDA. Apologies for the late release of this video. Fortunately, it hasn't been the most interesting of weeks so far. I'd say it's really been a week of reflection. Of course, last week we had a number of major economic events, most notably the first rate hike in more than a decade from the Bank of England. We also had the release of tax reform measures in the US. Of course, these are likely to be changed over the coming weeks and months before it actually passes. We also had the announcement of the new Fed chair. That's going to be Jerome Powell, who's already a member of the Board of Governors. We had the Fed decision itself, which was something of a non-event in the end. Everything there was as expected. Among a number of other events as well, which I won't go into too much detail on. This week's been a lot quieter. We have had a couple of central bank announcements, which I'll touch on shortly when I get to the charts. But in reality, the data we've had this week has been low and medium tier data, and the central bank announcements have not really been of too much interest. So rather than spend too much time on the fundamentals, I will jump straight into the charts, which you should be able to see on your screens right in front of you now. In terms of euro dollar, there haven't been too many actual developments here. We did see the break of the neckline of the initial head and shoulders, which I've touched on in previous videos following the 50 fib bounce. We've tested this from below currently, and that's held so far as resistance, which is always a good sign. We've then made a new low, and now we're in some consolidation. The thing that concerns me here is that we're nowhere near we've nowhere near completed the move of this head and shoulders. From a conservative possible price projection, we're looking at a move back to say 114.75, 114.50, which would bring us back here. That would be the shoulder to the neckline projected lower. On a more aggressive possible price projection, you'd be looking from the head to the shoulder projected lower, which would take us back towards these kind of 112, late 112s, 113 levels, looking around here, which coincides with this prior support and resistance. But instead, we seem to have run into some support just below the previous low. And more importantly, we've seen this come on lower momentum, so we can see this divergence forming now on both the stochastic but also the MACD histogram. We're also seeing the flattening of the MACD moving averages as well. Now, what that suggests to me, it doesn't suggest to me, to begin with, and just to stress, it doesn't suggest that this is a false head and shoulders breakout. What it says to me is we did find initial resistance from prior zone of support previously. Don't be surprised if we see a bigger correction to the upside. So if we go through this neckline and we see a bigger correction, that again does not mean that we're not going to see this head and shoulders complete. It just means that the neckline may not be the zone of resistance we're hoping for. Now, that's not guaranteed, of course. We could see a rotation lower, we could see lower lows made, at which point I'll be keeping a close eye on these moving average, these momentum indicators, because should momentum move with the bears at the time making new lows, then that would make me feel far more comfortable for a move into these 114.75 kind of levels initially. But should we see more divergence, we could still reach these 114.75s, but these divergences would make me a concerned bear, I should say. I think that would suggest to me that we are going to see a bit more of a correction before we see these more aggressive price projections potentially being hit. Cable's very much range bound. We had that decision last week. The Bank of England raised interest rates back to 0.5%, what the central bank considered to be the lower bound for around 7 years prior to last year's Brexit referendum. It's worth stressing, so still extremely accommodative. They alluded to 2 more rate hikes over the next 3 years, so still a very cautious stance. And much of the language which we had from the Bank of England did come across as quite dovish, and I think that's why we saw this move on Thursday. This is a culmination of profit taking, because the Bank of England did not exceed expectations by any stretch of the imagination, but also the dovishness as well weighed on the pound also. Interestingly, it came back to these 130, 130.50, 130 zone, which has previously been a zone of support, and it did rebound off here. Also, interestingly, we did see a rebound. We've retraced around half the move, maybe a little bit more, and we've run immediately into resistance. So it's going to be the next week or so. I think it's going to be very interesting for this pair. At the moment, it's clearly range bound. You've got 133.50 to the upside, 130.50 to the downside. The fact that we had this big negative candle here suggests to me that the momentum, if there is any, is with the bears. The fact that we've run into resistance halfway through that candle also suggests to me there's momentum with the bears. I'd like to see this 130.50 tested again. And if that's broken, and if the 130 is broken, then that would suggest to me that we're headed back towards this kind of 128 area, which is where we were prior to the rate hike becoming a possibility and then a reality. But don't write off the possibility that this remains range bound, simply in the near term at least, simply because I think the pound is now less reliant on the Bank of England, which is unlikely to move for me for the next 12 months at least. I'm probably more reliant on things like Brexit negotiations, and if we see no progress here, that could be negative for the pound as well. But as I've stated previously in previous videos, I'm still bullish the dollar into the end of the year and potentially beyond, and that could be what drives us through these kind of 130s back towards the 128s. Euro sterling is also range bound still. We also ran in support around prior support here. This is around the 87.50s. I think what we're looking at with this pair is a battle of the bears, because I think, if like I highlighted with the euro dollar, it's looking quite weak in the near to medium term. The pound is potentially also looking weak against the dollar, and could potentially face Brexit weakness as well. Now, what we're seeing signs of here is that the euro is potentially a little bit weaker than the pound in the near term. We remain range bound, but for me, the 87.50s look more likely to break than the 90s. There's no reason why we couldn't continue to trade in there, but a break of the 87.50s wouldn't just take us below current zone support, it would also take us below 200 and 233 day simple moving average, which would be quite a bearish move. The next support comes around this kind of 86.50 levels, but a break of this level would suggest to me further downside is potentially on the horizon. Aussie dollar, US dollar next, and we've been sideways trading now for much of the last 2 weeks. There's not much trade changed here since the last video. We did have an RBA rate decision earlier in the week. It was a non-event really. They didn't change their stance. They still want to remain accommodative for a sustained period of time. They're still facing the same challenges which they were previously. They are seeing improvements, and they do expect things like GDP growth to return to around 3% and remain around these levels, but things like inflation remains a concern, wages remain a concern as well, and therefore they are going to remain accommodative. They did highlight Sydney house prices as having improved slightly, and by improved I mean cooled, because there was concerns about a housing bubble here. But the ultimate message was more of the same, and that's what the markets were expecting. So we've been sideways trading here. Still, I remain bearish on this, if anything. 1, because of the US dollar. 2, because we broke through this previous support. We found resistance here. We've broken into this moving average band, the 200 and 233 day simple moving average. The 200 days been broken, and that's providing some resistance. So barring a break back through these 77.50s, I think I still remain somewhat bearish on this pair. And even if we do see a break of the 77.50s, I'm not particularly bullish either. I'd need to see a break through 79 to become in any way bullish on this currency pair. Dollar CAD is we're at a bit of an interesting phase, to be honest, in this currency pair, because we have run into resistance on 2 occasions around this 50 fib and rotated lower, and typically, given the trend which came before it, that would make me lean more towards being bearish than bullish. But there's a couple of factors at play here. 1, the US dollar I still believe in till the end of the year and maybe beyond. The Canadian Central Bank signalled a slightly less hawkish or even slightly dovish intention at the last meeting, which would typically be bearish for the Canadian dollar. And momentum, at least over the course of the last month or two, has been very much with the bulls. We've taken out these previous highs, which is a bullish signal. We're now trading around this prior resistance, which could be proved to be offer some support around 126 through 126.50, even 127. And we're struggling to gather any momentum to the downside, which you'd typically expect off of this 50 fib bounce if this was nothing more than a retracement. Maybe it's just an inkling, maybe it's a dollar bias, but I think there's still potentially more upside to come in this pair. I think 130 could be a very interesting level, and that will give us far more insight, and that's what I want to see hit at the very least before I make up a significant judgment on this. I think a breakthrough 130 could signal a bit more of a bullish move, particularly towards these kind of 132s, a rotation lower, and 130 being hit on significantly less momentum would give me much more confidence in the downside potential of this pair. Sterling CAD, like many of the pound pairs, is just a bit messy right now, and you'll see the same with sterling yen. I think while this trend line remains intact, I've got to remain bullish if I am holding a particular bias in this pair. But then it's very difficult to be too bullish when we are seeing moves like this in the pound on Super Thursday. I think 72 still remains a notable level of resistance, prior support, and we also found resistance here recently prior to the Bank of England decision. 170 could be another interesting level as well to keep an eye out on. But until we see a break of this trendline support, then it's hard to be too bearish on this pair. Like I say, I think the pound in many cases against many different currencies is just a bit chaotic at the minute, so it's hard to form too significant a judgment either upside or downside. Kiwi dollar is continuing its moderate recovery off the lows. We had the completion of this head and shoulders. It was a long-term head and shoulders, but actually completed even the aggressive move quite quickly. So we can remove things like this, which was the run off the 50 fib. We can remove the neckline because this is now complete, and just focus more on the near term. In the near term, we are seeing something of a recovery at this moment in time. We had the RBNZ announcement overnight. We had a bit of a rebound, a bit of a rally in the Kiwi dollar on the back of that, around 50 pips against the US dollar, so not overly significant. Broadly speaking, the RBNZ maintained its neutral stance. With regards to interest rates, is planning to remain very accommodative for a significant period of time, as with the Australian Central Bank. It did mention the inflationary impacts of the weaker Kiwi dollar, and when you consider that this move from July through to October is around, I think, just shy of 10%, then of course that is going to have an inflationary impact. So the fact that they did note that potentially it lifted the New Zealand dollar a little bit, because if we remain around these levels and we do start to see that inflation flow through, it could encourage the RBNZ to tighten slightly in order to offset that. But really the move was quite moderate, and given the weakness that we've had in the Kiwi dollar over the course of this period, I think it potentially is not taking a huge amount to provide some uplift here. But still, we're not exactly racing higher. This is looks more like consolidation, slight retracement to me. I think 70 is going to be an interesting test for this. I wouldn't be surprised if we rotate lower. Above that, 70.50 through 71 could be interesting, with it having been a prior zone of support and resistance. That'd be an interesting test as well. Potentially keep an eye on the fib retracement levels, because if my thinking is correct and we are looking at a stronger dollar into the end of the year, then these could be of interest. Where you want to draw your fibs is entirely up to you. You could just be looking at the recent move to give you an indication. You could be looking at this move here, where the 38.2 actually coincides very nicely with that prior area of support. Personally, I like to keep an eye on the bigger fibs, but I guess that's each their own. Like I say, 70 in the near term. If we break through here, then 70.50 to 71 could become a key zone of potential resistance. We'll wrap things up with the yen pairs. not much has changed in the dollar yen. The only thing I'd say, add to what we said in last week's video, is we've had another number of long upper wicks. So every time we seem to approach this 114.50 level, it gets rejected. This has happened on a number of occasions now. Momentum is very much now fallen out the rally. Does that suggest to me that we're not going to see a break of 114.50 and the rally's over? Absolutely not. A break of 113 may signal a near-term correction back to potentially 112 or just below, maybe around these 111.75s, which would bring us back in touching distance of the cloud. But in reality, I still think this pair looks bullish. We continue to make higher lows, so there's no reason to doubt it. Of course, I'd be a cautious bull at this point because momentum isn't with the move, but only a break of 113 would make me think that more downside is to come. I still think in the longer term this pair looks bullish because I am bullish on the US dollar. Like I say, 113 key to the downside, 114.50 is key to the upside, and nothing's changed there. Sterling yen, again, chaos, as per most sterling pairs. The levels I'm really keeping an eye on here to the downside of 147.75 through 148.75-ish. That's number of resistance levels previously, so turn support. We didn't find too much support on this first test here, but we did on the second time. And it also coincides nicely as well with the 55-day simple moving average, the top of the Ichimoku cloud, and that rising trend line, which I've highlighted before. While it was broke, it was a notable trend line previously, so it's not necessarily a significant trend line, and I will actually just drop that down to a single bar, but it's a notable level of interest, I'd say. And the fact that all these coincide do make it a notable zone, or a key zone of potential support for me. A breakthrough there, and I'd be looking back towards these kind of 146s around the bottom of the Ichimoku cloud, but I think this could be a big test in the near term for this pair. But like I say, we're not really seeing any major trend forming here. We're just seeing a lot of choppiness. Finally, euro yen, and nothing's changed here again. The necklines of this double top still remains in play. I like the fact that we had only around a 50% retracement of the move from the recent peak to the recent low, and you can see this just here. It was pretty much 50 fib and then rotate lower. Nothing's changed from the last video. I think I'm still bearish on this one. If we do see a break of this neckline, the double top neckline projected low would take us back towards these kinds of levels. Would also take us below the 55.89 moving average and below the Ichimoku cloud as well, and potentially signal a broader correction. We've seen a very strong rally in euro yen. It's very much lost the momentum which got it up there. I think we're due a correction, and we're just waiting really confirmation from a break of the double top neckline, which should or could take us through the Ichimoku cloud, through those moving averages, and trigger a broader move to the downside. So nothing's changed here. If anything, it's just reaffirmed my position, and I'm just waiting for the confirmation. That's all we got time for today. I hope you all found that useful. Please do join us again next week for another video, and in the meantime, good luck with your trading, and I hope you all have a fantastic weekend.